In a strategic move that's reshaping the AI hardware landscape, Google and Meta announced a landmark partnership on November 25th, 2025. Google will supply its custom tensor processing units to Meta for AI training workloads, marking a significant shift in how major tech companies approach their AI infrastructure needs. This isn't just a simple supplier agreement. It's a multi-billion-dollar partnership valued at $2 to $3 billion initially, with the potential to scale significantly. Meta gains access to Google's advanced TPU v5 pods at pricing that's 20 to 30% below current NVIDIA rates, while Google opens up a new revenue stream beyond its cloud services. The deployment will roll out in phases, starting in Q1 2026, with Meta committing to shift 10 to 20% of its AI compute to Google TPUs over the following years. This represents one of the most significant challenges to date to NVIDIA's dominance in the AI accelerator market. Market share analysis. To understand the full impact of this deal, we need to examine the current AI chip market landscape. NVIDIA absolutely dominates this space with a staggering 92% market share in AI GPUs. Their CUDA ecosystem has created an incredibly strong moat that's been nearly impossible for competitors to breach. However, custom ASICs like Google's TPUs are the fastest growing segment, expanding at 50% year over year. While they currently represent only 2 to 3% of the market internally at Google, this external push could capture 1 to 2% of the overall market by 2027. According to McKinsey analysis, we're looking at custom ASICs reaching 30% of total AI spending by 2030. This deal accelerates that timeline and signals a fundamental shift in how hyperscalers are thinking about their AI infrastructure strategy. Vendor impact analysis. Now let's examine who wins and who loses in this new landscape. NVIDIA bears the brunt of this deal, and the impact is substantial. Meta accounts for 10 to 15% of NVIDIA's data center revenue, which translates to over $10 billion annually. A 20% shift to TPUs means approximately $2 billion in lost revenue for NVIDIA, potentially trimming 5 to 8% off their projected 50% year-on-year growth for 2026. The market reacted immediately, with NVIDIA stock dipping 1.2% on the news. AMD stands to gain modestly as Meta's number 2 supplier, with potential for 2 to 5% order uplift. Intel sees neutral to positive effects from their Gaudi pilot programs, but the clear winner is Google, whose stock rose 2.1 to 2.5% on the announcement. Investment recommendations. So what does this mean for your portfolio? We're issuing clear recommendations based on 3 potential scenarios with weighted probabilities. For Alphabet, that's Google's parent company, we're bullish. TPU sales could add $5 billion in revenue by 2028, diversifying their hardware business beyond cloud services. For Meta, we're neutral. The cost savings are substantial, but execution risks remain as they navigate this new multi-vendor strategy. For NVIDIA, we're bearish and recommend trimming positions if volume commitments confirm. In our base case scenario, which has 60% probability, we project a 5% revenue impact to NVIDIA, while Google gains $2 billion in new TPU revenue. Investors should pay close attention to Meta's December 4th earnings call, where we expect more details on the partnership's scale and timeline. Slide 5. Strategic implications. Looking beyond immediate financial impacts, this deal signals a fundamental restructuring of the AI hardware ecosystem. Custom ASICs are no longer a niche play. They're becoming a strategic imperative for companies operating at scale. Consider the energy implications. AI data centers now consume 2 to 3% of global electricity. Efficiency improvements aren't just about cost savings anymore. They're about sustainable scaling. Google's TPUs offers significant advantages here, which becomes a competitive differentiator. Forward-looking conclusion. We're watching 2 key developments. First, how NVIDIA responds with their software strategy through CUDA-X. Second, potential antitrust scrutiny. The FTC is likely to review this partnership, adding 10 to 15% uncertainty to our projections. The clear takeaway for investors: position your portfolio for ASIC growth while maintaining diversified semiconductor exposure. This isn't the end of NVIDIA's dominance, but it's certainly the beginning of a more competitive, multi-vendor AI hardware landscape.